Hi, welcome to my video. My name is Suryo. I'm studying at IPMI Executive MBA March 2017 intake. I want to explain about Nobel Prize winner in economy in 1990. The Royal Swedish Academy of Science has decided to award the 1990 Alfred Nobel Memorial Prize in Economic Science with one-third each to Professor Harry Markowitz, University of New York, Professor Merton Miller, University of Chicago, Professor William Sharp, Stanford University, for their pioneering work in theory of financial economics. Harry Markowitz is awarded the prize for having developed the theory of portfolio choice, while William Sharp for his contribution to the theory of price formation for financial assets, the so-called Capital Asset Pricing Model (CAPM), and Professor Merton Miller for his fundamental contribution to the theory of corporate finance. Let's watch the explanation.
Even at 83, Harry Markowitz is still a real workaholic. He teaches as a professor at the University of California in San Diego, advises various financial institutions, and is writing 3 books at the same time. Markowitz achieved world fame in the early 1950s with his modern portfolio theory, for which he received the Nobel Prize in Economics in 1990. For decades, his theories on diversification were considered as almost incontrovertible parameters for capital investment. Markowitz's portfolio theory came under criticism during the financial market crisis, but he was glad of the attention.
It gives me a good opportunity to teach about portfolio theory. It doesn't change my mind about portfolio theory.
Markowitz defended his theory, saying that he had never claimed markets were calculable or predictable. In his conviction, the market is often very volatile for only short phases. This gives rise to unaccustomed correlations that may also override diversification effects for a while.
Even if you could use God's own probability distribution of returns on securities, there still wouldn't be one perfect portfolio, because remember, what portfolio theory offers is a risk-return trade-off. So what's the right portfolio for one party is the wrong portfolio.
If you have 2 assets, A and B, and you can only choose one of them, how to select? First, you have to know the return, which is the average, and then the risk is the standard deviation. Look at this example. Both assets giving the same return, the same average, which is 6%, but the risk is different. Asset A, the standard deviation is 0.82%, while asset B is much higher, which is 11.6%. Now, if you want to combine asset A and B, how much is the return and the risk of the combined asset? It depends on the composition, the correlation, and each return and risk of asset A and B. So a combined portfolio A and B, this is the formula how to calculate the return. This is only applicable for to combine 2 assets. In 3 assets, there are different formula, and this is how you calculate the risk. So this is the sample of combination. Let's say the asset A is 30%, the composition, and the asset B is 70%. And the correlation between asset A and B is 0.8. You can easily calculate this with using Excel. And this is the return of the combined portfolio is 4.9%, with the same return is 6%. So after you get the return and the risk of the combined asset, you can plot it into the graph here. And then if you try another many combination of asset A and B, different weight for each, and you dot it into the graph with the same way, you get this frontier graph. So the most upper right is the best option for the risk taker, which is giving the highest return with also of course the high risk, and the left blue dot is the best option for the risk averse, because the return is the optimum return with the lowest risk.
It has to do with the relationship between the price of a security, its risks, and its expected return. And there are really sort of two key takeaways, if you will. One is that in that setting, the most efficient strategy for an investor is to hold basically a broadly diversified portfolio reflecting the market of securities that are available. And that gave birth to the notion of index funds. And the second is that there will be a reward in higher expected return, not guaranteed, but expected, for bearing risk. But the kind of risk for which the reward should be available is the risk of doing badly in bad times.
What happens if we combine a risk-free asset and a risky asset? Well, before you have to know that a risk-free asset, for example, is like the government bonds. So you remember this complex formula? Well, if the risk of asset B is 0, then basically the risk of the portfolio is only depend on the weight of the risky asset multiplied by the risk of asset A. So you can draw this graph, and this line is called capital allocation line. This theory assumes that all investors have a homogeneous expectation, so they will face the same efficient frontier of risky portfolio and also have the same optimal risky portfolio and same CAL. So under the assumption, the optimal CAL for all investors, we call it capital market line. Security market line, which is also called characteristics line, is a graphical representation of the market risk and return at a given time. The difference with the CML using standard deviation as the measure of risk, while in the security market line using beta coefficient as a risk factor. And another difference is, while the capital market line graph define efficient portfolio only, the SML graph define both efficient and non-efficient portfolio. From the SML graph, we can know the equation of the SML is return is risk-free plus beta multiplied by market premium, where the market premium is the expected return of market portfolio minus risk-free asset. This equation is famous with the name of capital asset pricing model, CAPM. There is 3 ways to raise capital of a firm or corporate to fund its business or finance. First is common equity, second is debt, third is by preferred stock. The weighted average cost of capital, WACC, is the marginal cost of raising additional capital and is affected by the cost of capital and the proportion of each source of capital. But this video I will focus only for the common equity and debt. This is the formula to calculate the cost of capital, or WACC. So basically the formula is weight of the debt multiplied by the return of debt but minus the tax, and you add it with the weighted of the equity multiplied by return of the equity. So how to calculate the cost of equity? One way to calculate the cost of equity is using the CAPM formula from William Schwab. But there is 2 other ways to calculate the cost of equity, which is one is dividend model approach and the other is the bond yield plus risk premium, which we will not discuss here. So what is the application of this theory? Well, in the business, despite of a lot of assumption using in this portfolio theory, to simplify, a lot of use in investment management. For example, to help investor to choose the optimum portfolio and risk and return. Example in the stock market, securities, and in the corporate finance, where the firm or corporate use WACC as a benchmark on how much a project or investment or regular business of a company should have the minimum return, and then is also used for valuation of a company. So I can summarize that this in the business daily, this theory is not perfect, but it's very useful. So you already watched my video about the explanation of Nobel Prize winner in economy 1990. I hope you can easily understand this video. So thank you very much for watching this video. See you in the next video.